I am David Geraccioti, Editor-in-Chief of wealthmanagement.com, the digital resource for Rep Magazine and Trust and Estates, and coming to you live from the Morningstar Conference in Chicago. With me today, I have Doug Ramsey, who is the Chief Investment Officer for the Leuthold Group. They run a family of mutual funds. Thank you for sitting down with me.
Thank you for having me, David.
I always enjoy reading the Green Book. It's one of my favorite reads. It's a little hard to get through sometimes.
It's a little hard to put it out at times.
Well, it's funny. I mean, you guys are funny. It's one of the most unusual research pieces of research you'll ever get, because it's funny. I mean, well, we were just talking about the bubble vision comment you made about CNBC bubble. I love that. I've been using that and not footnoting you. But anyway, what I wanted to ask you, in your research in the Green Book for June, I guess it was, you talked about U.S. Treasury securities. Is there a bubble? I mean, I'm not going to give the government my money for 10 years for 1.6 or whatever it is.
Yeah, neither are we. As we've come to think about this over the last really number of months, in our minds, I mean, yes, long-term Treasury bonds have achieved bubble status. I mean, the problem with timing the peak of a bubble is, I mean, these things can inflate greater than you ever expect. In the case in point, internet stocks back in 99, 2000. But as we've come to think about it, the bubble is actually broader than just Treasury securities, but it's what I describe as volatility minimization. It's assets that deliver a low volatility return stream that, in my mind, are broadly overvalued. So Treasury securities, and in fact, most debt. I mean, we do have some bonds, but they're on the very short end of the maturity spectrum. Generally, even spread product. I mean,
I wanted to ask you, what does spread product mean?
Spread product would be, anything that normally commands an interest rate premium relative to Treasury. So it could be high quality short-term corporate debt, which I think looks okay to us. It could be way out on the risk spectrum in terms of high yield bonds, which don't really offer a lot of, I don't think they're ridiculously overpriced, but the spreads are, not the fat pitch that we saw a few years ago.
I was wondering if you meant spread product, meaning there was a trade or some way to put on, something fancy.
No, just
to mitigate it. So I asked Dan Fuss this a minute ago. How do you guys get yield? And when you have your retail, your registered investment advisory calling you up, what do I do? How do I get income?
Well,
Dan said, go back in history. Take a time machine and go back.
I wish we could do that with all the historical charts that we studied and what used to be available on fixed income. But I think, it's a mistake to be a yield chaser, really at any time, but particularly now. And we're focused on total return. And quite frankly, what's cheap today is higher volatility stuff. I mean, it's long-term ownership assets, i.e. common stocks. And in particular, we would tend to say that U.S. stocks broadly are around, sort of in a broad fair value zone. It's stocks right now outside the U.S. that
you do your normalized 5-year normalized earnings, right?
Yep.
Okay. Just so the readership understands that. That's how you define it over a cycle.
Exactly. The idea of just smoothing out, you're going to have cyclical highs like you had in 07, and just 18 months later, bottom in 09, and earnings went from $90 to $7 on the S&P. So you need to smooth those out.
Right. So what's a financial advisor to do?
It's very difficult if you have clients that have an immediate income need. And it's not only, as I said, the bubble is broader than just Treasury securities and bonds in general. It's volatility minimization. So as a result, you see very high PE premiums on high dividend yield stocks that trade like bonds. I don't know that I describe them as a bubble, but they're very rich relative to the rest of the market. So it's almost as if you've got to adopt this total return framework and say, look, I'm going to stomach some short-term volatility and return for an attractive return on a 2 to 5 year time horizon.
And one last quick question before we go is, the April-May swoon, it's kind of
3 years in a row now.
Yeah, it's just kind of scary. Is this a bear or a correction?
Correction in our mind. Peak to trough, the correction was 9.9%. It's right in the range of what we would define as an intermediate correction, which would be the 7 to 12% zone. The reaction to it has been so dramatic, I think, because, well, A, the nature of the scary headlines coming out of Europe is just something that we, it's not like a normal inventory correction recession, of which we've had a dozen in the post-World War II period. It's something very new and unfamiliar to us. The other fact is, keep in mind, we had a 57% bear market from 2007 to 2009. We had a double dip scare and a 17% decline in 2010. We had nearly a 20% decline in another double dip scare. And the fact that this market top again arose in the same month as the last two in 2010 and 2011, there's too much similarity. So that's why I think even though the correction was contained at just under 10%, it elicited this very emotional response. And we're certainly seeing it in terms of flows going out of U.S. focused equity mutual funds. There's no appetite there. And there should be.
Well, okay. Well, thank you very much for talking with us.
Thank you, David.
I am glad you stopped by.
Great pleasure.
David Jerichotti with Doug Ramsey, who is the Chief Investment Officer of the Leuthold Group. And we're coming to you from wealthmanagement.com's booth at Morningstar Conference in Chicago. Thanks.